something, I see it through, and I realize pretty quickly the advantages of overcoming the obstacles to sales would propel my entire career forward. What did I learn? Number one, I learned how to get out of my comfort zone. Number two, I learned how to deal with rejection. Number three, I learned how to listen and ask the right questions. Number four, I learned how to build rapport with people and act myself, even in uncomfortable situations. Number five, I learned how to help people, be on their side of the table, help them make decisions, make them feel comfortable. All the things that I do today as an MD at JP Morgan. And turned out that I was actually pretty good at it once I got through all those barriers and obstacles. I could not have made it up the ladder in finance had I not disciplined myself and become a seasoned salesperson in another industry first.
I love that. So sales, what was the next job after sales?
I was plucked out of my sales position by a client of mine who gave me a company to run. I was 28 years old. I ran a division of Wang. There was an old computer company called Wang. There was a spinoff called Wang Recovery Systems, which was the disaster recovery business. Those of you in IT know what that is. I was given this business at 27 to run by a client of mine. At the age of 28, we sold the company to SunGard Data Systems for $29 million of cash. And my bosses quickly realized that I'm pretty good at figuring stuff out. My third gig.
Well, let's talk about that $29 million score.
Yeah, what did you do with that? What did you do with all that money? Did you start your own company?
Oh, no, I didn't. 1 second. It wasn't my $29 million. It was my boss's. I got a box of chocolates.
I love that.
I got a bonus and a box of chocolates. Bittersweet chocolate, I would add. It wasn't even milk chocolate. I was 29 years old, too young to have understood the word equity.
Okay.
And I did it. I turned this company around rather quickly. They sold it, and they just shifted me from that into some other business that they owned.
I love that. So let's go into depth about how you were able to build it to that $29 million valuation. So, and actually sell it. So what were some of the things that you did when you first got in there where you were able to turn the tide of that business and actually get it to an exit faster than that boss would ever?
Okay, so it was a lot of fortuitous luck and a lot of out of the box thinking. If you guys remember, there was a disaster called the TWA Flight 800 disaster.
Yes.
Where a plane blew up. Immediately after that, what happened is that the NTSB realized that most of the smaller airlines would not be equipped with call centers if, God forbid, they had a disaster. So let's take Arabian Air or Jordanian Air as an example, which were two of my clients. If a Jordanian Air crashed at JFK Airport, thousands of people would be calling to find out what happened. And Jordanian Air does not have a call center. So we had a call center in Manhattan in an incredible location. And right when this happened, I realized that I can sell disaster recovery services to airlines for the eventuality of something, God forbid, happening. I signed them up to the tune of $10,000 per month. I signed up my first 15 or 20 airlines. Before I did that, I went to Washington and I presented a plan to the NTSB. I met with their attorneys. I was 29 years old. I met with the attorneys at the NTSB. They all signed off on the plan of what I was going to do. They would basically say that any airline that signed up for me would have, because they were mandating this. And then I started signing up airlines. It didn't take more than 3 or 4 months for SunGard Data Systems to say, we like this idea, and they bought the company.
Wow. Okay. So you have that score, build some confidence within you, right?
Correct.
And what was the next move after that score?
The next move after that was they moved me into commercial real estate. This was a
Okay.
very wealthy family, and I was involved for about a year in buying very, very large Manhattan properties. So I was doing due diligence, I was scouting properties, negotiating, and so on. I loved it. If I had my way, that's where I would have stayed.
Mm-hmm.
But after about a year, they asked me to move into they had a corporate finance company that was working with public companies. And it started as what was supposed to be a 3-month stint to revamp their sales and marketing. And they ended up forcing me. I mean, there's no forcing, but they made it almost impossible for me to leave. And I spent 5 years in the corporate finance space. Um, Enjoyed it, traveled a lot, met with the boards of some fairly large Fortune 500 companies, closed some very large business, traveled incessantly around the country. It was getting to me after a while, and there was also only that much I could earn. I was hitting a ceiling in terms of my earning potential, and I realized that there's a lot more out there. And that's when I pivoted into wealth management.
Okay, so
Nice. Quick question.
Max,
So-
Max, we're gonna have a Q&A at the end. So no problem, but we'll make sure to hit all of your questions. So, Mark, quick question here. So, as you're progressing through the space and you go into wealth management, right? What piece of advice could you give us as people that are just out of college, high school, right? What piece of advice would you give us from the understanding of your journey and how we could potentially apply some of the principles that you learned, right? And how we could take those principles and actually make our own. So what piece of advice would you give a 20-year-old right now that, has no idea, right, about what they want to do? They know they have a lot of potential. They might be potentially even working in an investment bank. They might be working at a great company, but they know that that's not where they want to end up. What piece of advice would you give them?
So the first advice is what I started with. I don't think any of you know where you're going to end up. If you're going to medical school, you're obviously going to be a doctor. That doesn't mean you're going to end up as a doctor. I have several clients that are successful entrepreneurs that took companies public, that started their lives as doctors, dentists, lawyers, accountants, and so on. No one really knows where they're going to end up. If you're going for a business degree, you certainly don't know where you're going to end up. Try not to think about it too much. Try to think about the next step. And what I always focused on, I never focused on how much I was earning. Let's start with that. A lot of people fixate on raises and how much comp they're getting and all that other stuff. I would say that I looked at the first 10 years of my career as paid internship. I was essentially there to absorb as much knowledge as I could, number one, which means that you should gravitate to companies, firms, and the people inside of them that can mentor you. I had some phenomenal mentors in my career. When I got to Wall Street, I had the chutzpah to pick up the phone and call one of the most successful Wall Street money managers, a guy by the name of Dick Weissman. He was a partner at Neuberger Berman, which is a competing firm to where I was working. I invited him to lunch, and guess what he said?
What'd he say?
Sure. And then I took him out to lunch, and I said, I have a deal for you, Mr. Weissman. How about once every 3 months, I feed you expensive steak and wine, and you allow me to pick your brain? And he said, it's my pleasure. He was my mentor for 3 years. All it took was me to pick up the phone and call him. A lot of people are intimidated to seek out mentors. Mentors got me where I am. Number one. Number two, you have to work on your skills. And the most important skills are your people skills. If you develop superior people skills, communication skills, you will be able to succeed in any industry. And that is where I focused my attention. When I got into sales, I realized that every transaction and every successful journey involves an interaction between one person and another, or one person and many others. And as teenagers, we don't spend a whole lot of time working on our people skills. So, in the business that I do, I am often sitting across somebody who is extraordinarily wealthy, but knows very little about what I do and how I do it, and doesn't understand the typical terminology that we throw around on Wall Street. So, what the difference between me and somebody else is, when I leave a room with a prospective client or a client, they always say the same thing. This was the most educational experience I've had in a long time. I feel like you're empowering me and you're making me feel smarter. Many people on Wall Street do the opposite. They think by making their clients feel stupid, they will somehow become irreplaceable. I believe if you educate and empower the person you're working with, that's the best way to build trust. That's an important people skill that I learned over time. The stories that I tell, the humor that I use, the way that I describe things, the way that I calm people down. I've read every book on behavioral economics and
We're going to
finance
go into that because we
that's
saw.
ever been written, and I taught it at NYU. These are the kinds of things you all should be thinking about. You want to be a rock star, start working on the way you interact with people in the business settings. Find people that you can learn from. Where that takes you, God only knows. But you'll see, you'll have an upward trajectory.
I mean, that I could not agree with you more. And my next question is, how do you find the courage? Let's say you're an introvert, right? And you naturally,
Which I am.
yeah, so you're an introvert, right? And it's scary to go out and meet people, and it's scary to, like, what colleges call it, network. And you don't feel comfortable doing it. You don't know how to approach somebody who's potentially extremely successful. You're like, I have nothing to offer them, right? This person has everything that they could have. Like, what am I going to offer this type of person? What piece of advice would you give a person that just feels that they have no ability to offer value in return for somebody's time?
So let's just start with the word introvert for a second,
Yes.
because I believe it's a misunderstood word. Um, I've taken what's called the Myers-Briggs test every year for the last 15 years. I get a kick out of it. My firm readily makes it available, and all the former firms I've worked for have done the same. And I've watched myself go from a somewhat clear extrovert, and I've crossed over to become a introvert, which is very typical. Many extroverts that are not clear extroverts, slowly, as they build wisdom and experience, will move towards being an introvert. When I tell people that I'm an introvert, they laugh because I have stood up in front of audiences of 10,000 people and I am not phased. But that doesn't make me an extrovert. The difference between an introvert and an extrovert has to do with where they draw their energy. And I am very, very bad at networking. If I walk into a party, I am the last person to walk around and schmooze with every single person in the room. I'm more likely to find one person that I think looks interesting and spend quality time getting to know them and then move on to a second person. When I leave that room, 99% of the room will not know that I was there. I do not get phased from audiences that I speak in front of, and I do not get intimidated by people, which has nothing to do with being an introvert and an extrovert. It has to do with confidence. It has to do with whether or not you believe, to your point, Mitch, that you have value to add. And the only way you will convince yourself that you have value to add is when you become expert at something.
Yes.
And if you don't become expert at something, then your feelings will dictate how you come across. I don't care if you're an introvert or an extrovert. You're going to be hesitant. You're not going to be sure of yourself. You're not going to make eye contact. The person is going to realize that you do not feel comfortable in this conversation. Versus When I walk into a room, I don't care if the person's worth 100 million or a billion or 5 billion. To me, it's completely irrelevant. I don't see myself any different than a surgeon walking into a room to perform surgery or a doctor coming in to examine a patient. It doesn't matter who the patient is. It should be irrelevant. At the end of the day, I'm the doctor, you're the patient, and I'm here to help you. Whenever I'm interacting with people, I'm fixated on not any wealth differential that may exist between us or even an age differential. It's only about what I have that they need and me feeling confident that I have a way to help them. And that takes time. It certainly takes time. You build that confidence with time, with knowledge, and with successes. So your first win is not going to be an elephant. You're probably going to shoot a little mouse, but you'll work your way up to squirrels and raccoons, and then one day you'll be an elephant hunter.
Let's talk a little bit about your behavioral economics course at NYU. So, first of all, how did you get into behavioral economics?
So I got into behavioral economics in 2008 when the world collapsed and the market crashed 2%. I started having this sense even years before that, that Wall Street was ill-equipped to deal with market sell-offs. And if you look at the data, there's something called the Dalbar study, which shows that the average investor underperforms the S&P by about 6% per year on average. And the reason is that they don't hold on during times of turmoil. So they essentially always buy high and sell low. This is a very famous study, and it's essentially a behavioral economics study because it says that human beings are very bad investors. Now, if that's true, that means that Wall Street, who's supposed to be there to stop people from making these bad mistakes, are not doing a good job, are they? Right? If everybody's ditching their stocks during times of turmoil, and most people have a financial advisor, well, then what are the financial advisors doing? And that's something that always troubled me. So when I got really knee deep in Wall Street, I started thinking about this and I looked at some of the things that we traditionally show our clients. Charts. Wall Street loves charts. Any of you who are in a finance course, well, it's all about the charts. We have diagrams and charts. You don't believe me? Just Google the words JP Morgan Guide to the Markets and you'll see what we put out every single quarter. Just a lot of beautiful, gorgeous charts. Guess what? It turns out that nobody cares about charts when 50% of their money just evaporated. They're not interested. So when 2008 happened, I found the following. I didn't have the tools to help my clients.
Not right now, maybe in a bit.
I didn't have the language. I didn't have the psychological understanding of why people make bad mistakes during times of turmoil. So I realized I have to get really smart really quickly. So I started devouring books. Books from people like Danny Kahneman, Gary Belsky, and understanding the psychology of decision making as it pertains to finance. And I very quickly started putting this to work with my clients and in their conversations. And it worked. I had the highest, what we call non-capitulation rate at my former firm. 99% of my clients stayed invested through the 2008 turmoil and recovered completely and went on to earn a lot of money. The average below me was in the 70% range. My clients stayed invested. I started lecturing on this. Somebody at NYU picked up on it and invited me to become an adjunct professor. I put it together. It was a lot of fun. I still have all the different courses that I put together. I did it for a couple of years. I got my thrill. I earned my NYU card as a professor. Here it is. Still keep it. It's cute.
Yeah.
Notice my beard was.
We have quite a few NYU students on this call. I myself went to NYU. My Gilad on the call.
I love teaching. And then I didn't tell you the coolest part. The coolest part was I didn't have time. My schedule was crazy busy to go down to the campus and teach twice a week. So they actually brought the students to my Wall Street firm.
That's amazing.
It was a lot of fun. Anyway, I took behavioral finance much further because from that, I started studying psychology, period. Decision-making psychology, right? I find watching people make decisions in times of uncertainty with imperfect information, I find it to be absolutely fascinating. I could give you so many examples. I'd have you all rolling on the call. But I sometimes go with my wife shopping and I watch people look at labels and make decisions on whether they should buy the dress based on how many times it was marked down, which is absolutely ludicrous. I mean, I have this conversation with my wife all the time. She comes home, she's got a bargain on these shoes. I said, why? She says, they only paid $180 for them. I said, so who said they're worth more? She says, what do you mean? They were originally $900. I said, if they were worth $900, they would have sold for $900. And then she shows me the label. And it was marked down from $900 to $500, to $500 to $400, $400 to $300. And this is the way humans make decisions. I see people comparing cans of tuna for 24-cent difference. And those same people walk into a restaurant not think twice about buying a tuna sandwich for $9.85 plus tax. It's mind-boggling. It really is. And it's fun. And if you want to have fun, read Dan Ariely's book, Predictably Irrational, which was probably the first book that I read. But I find this to be humorous because we as humans, as smart and advanced as we are really silly sometimes in the way we make decisions. So this is both a business acumen that I've developed, but also a fascination and a pastime. So
that's I mean, psych is in everything we do. And we have somebody on the call here. Her name's Maya Messer. She runs a psych podcast called Psych Mike. And I think Mark and Maya, I think there could be a lot of synergy. So I'll definitely connect you. She's interviewed tons of psychologists, and it's very interesting to find the intersection between finance and how people make decisions on investing and human psychology. And I think there's a lot of
the whole market is a basket of people making most of the time irrational decisions over the short term.
Yes, and there's a reason for that.
That's right, and you can capitalize on that. You can actually predict what the market will do given a piece of news and the opportunities that it will make.
Yeah,
I just wait for these opportunities. I wait for these opportunities to swap. At the beginning of COVID, I bought up stocks that had run away from me that I never dreamt I would see at the prices that I did. I'm up between 400 and 900% on every one of these stocks.
Yeah, I mean, that's, first of all, whenever I hear success, that is unbelievable.
But that's there for the taking when you can think more rational than the people that are driving the market on any given day.
So how do you keep a cool head under that amount of pressure where you have clients like, yo, what's going on? Should we get out? Like, how are you able to keep that coolness, right? It's all easy to talk about in theory, but when you see your portfolio get slashed in half, right? Say you have a $10 million portfolio and then all of a sudden it's $5 million bucks. That doesn't feel good. So how are you able to stay rational in those moments? What techniques have you learned? Because no matter what, humans are humans, and even if you are educated, correct, emotions still get in the way.
So, interestingly enough, in the beginning of COVID, I had COVID. I had it in March. I had it. They were giving it out for free, and I said, "Why not?"
I agree. It's free.
It's free. Let me get it over with.
On sale.
Let me get my crazy antibodies and put this thing to bed.
Yes.
I was pretty sick when COVID hit and the market crashed. I don't think I got a single client call.
Wow.
Now, that's because I work on my clients during times of sanity.
Got it.
And I prepare them for times of insanity. That's number one. Number two, all market irrationality comes down to one thing: short-term fixation. Everybody's fixated on the moment. Where investing is all about the long term. So let's take one of my favorite stocks, Shopify. You all know Shopify?
I've heard of it. Yes.
I own a boatload of Shopify personally. One of my biggest holdings, right? Shopify dropped from 9 something to, I think I paid $344 for it at the beginning of COVID. From 900 to 344. Now, let's forget the fact that COVID was the best thing that happened to e-commerce. But even if you didn't think about that for a second, do you think that whatever COVID would throw at us, it would actually change the course of history so that e-commerce would now become irrelevant? Or Microsoft or Amazon or Facebook or anything else? But all stocks were slashed 30 to 40%. And the market was slashed 30 to 40%. So think about capitalism. Do you think that COVID is going to derail capitalism forever? During 2008, I kept telling my clients the same thing. Whatever's happening today has happened in the past. Right? It's nothing as bad as the Great Depression, but even if you look at the Great Depression and you look 10, 15, 20 years later, the market was much, much higher. So what you have to do is you have to pull the client out of the moment and get them to fixate on the future. Now, also, there's a pendulum in the mind of every investor which swings from greed to fear. Right? That's the way people are. They're either feeling greedy or they're feeling fearful. When people are greedy, the market is euphoric. When people are fearful, the market is selling off. What I've learned is I need to introduce greed when there's an abundance of fear, and I need to introduce fear when there's an abundance of greed. When clients call me up today and say, Mark, why shouldn't I have every dollar of my money in stocks, sell all my bonds, let's go all in? My response is, let me give you 3 reasons why the market could sell off 50% tomorrow morning with the open. I introduce fear. On the flip side, when things are irrational and crazy and fearful, I start to speak about greed, about the opportunities, about looking back 5 years from now as this being the most perfect time to buy. I always tell my clients, the very best day to buy real estate in Japan was the day after Hiroshima and Nagasaki were bombed.
Wow, really?
That's right.
With the radiation.
You could have bought real estate for nothing. In those moments of the greatest fear and trepidation is when the seeds of the next recovery are planted. You have to find the way to get the client to see the future.
What about the saying, cash is king?
That's Andrea Waxman.
What was the question?
She asked, what's the saying, cash is king?
Cash is king?
Yeah.
Yeah.
I have no idea who said that. Cash is king.
In times of despair or like chaos.
I'll give you the time that, well, let's start with cash is miserable because it's a losing proposition. It's losing money to inflation, guaranteed. You don't see it because you open up your statement and it looks the same as last month. But trust me, you do that 1 year, 2 years, 3 years, you'll find yourself with 10 to 15% less buying power. Cash is king when there's a buying opportunity. That's the answer. There are a lot of people who sit on hordes of cash waiting for that buying opportunity. But guess what? By the time it actually comes, they would have been better off deploying that cash to begin with. Warren Buffett hates cash. I hate cash. In my portfolio, I have 0 cash.
Really? You hold
0.
no cash?
No, I personally. My clients have cash because they spend. The only time I would have cash in the portfolio as a tactical is if I believe that the market is ridiculously overpriced and is unjustified at its multiples. I may pull back some cash. Most oftentimes, that is not the case.
Very interesting. What asset class would you say that us high school, college, young professionals should we really study and focus and get a grip on at this moment in time?
The S&P 500, there's nothing better than it. It's simple. You can buy the total index, something like Vanguard Total Index, and you, if you're young and you are entrepreneurial, you may put a 10% overweight of technology on top of that. That's it. You don't need to know more than that at your age. There's no reason why. 90% of the geniuses out there will underperform the S&P 500 when all is said and done.
What are some key factors that you think about, or a checklist that you might have before investing in an index stock for a long-term period?
Well, an index is always a good idea because an index is an evolving subset of stocks, right? Look at the S&P 500 today. You can pull it up on your screen. Look at the top 10 holdings. I believe 9 out of those 10 were not even in the S&P 10 years ago. I think with the exception of Microsoft, Nvidia wasn't in the S&P, Tesla wasn't in the S&P. Go back and look at those stocks and see when they even entered the S&P. And today they are the top 10 holdings of the S&P. The technology sector in the S&P is today about 28% of the S&P.
Yeah.
When I began my career on Wall Street, it was less than half of that. The beauty of an index is it represents innovation in a most profound way. So you really can just buy the S&P, and what you're essentially doing is you're betting on capitalism.
Absolutely.
You're betting on innovation. You don't need to do anything more than that. You're going to do really, really well.
On that note, I think the audience has spoken that there's a lot of questions that I could feel in the air. So we're going to, first of all, thank you so much. This was incredible. We're going to open it up to Q&A. Guys, when you're asking a question, please have your cameras on. That way we can have real communication between Mark and you guys. So who has a question right now? You guys just put it in the chat. Who has a question? Okay, David, go ahead.
Hello, Mark. I have a question about your personal outlook on the market right now. So, as you know, the Federal Reserve is going to start tapering its debt security purchases pretty soon. And in 2023, it looks like there's going to be an imminent rate hike. I was just looking through some stocks' balance sheets today, and a lot of them have variable rate interest on their loans, so they're kind of exposed. So I think that equities may drop in the next few years, especially ones that have a very high debt. So that's my personal view. So my question is to you, are you at all concerned with the interest rate hikes and inflation? And if so, are you taking any sort of precautionary measures such as interest rate swaps or rebalancing the portfolio composition via sector rotations or different asset classes?
So the answer is no. In short, I've been on Wall Street now for 19 years in private wealth. What you just described to me, I can change the words and insert 3 other or 4 other variables that are just up ahead, because I've seen them all in 19 years. There's always something on the horizon, always. And yet, I look at it as there's almost nothing that's going to get me to change my long-term thesis, right? So, as I said before, it's about long-term. If you try to second guess the market and you try to play the rotation game, let me ask you a question, David. How many times in the last year and a half did you hear that there is a secular rotation out of growth to value? Have you been following those words? You know how many times the market has said it's over for growth, time to switch to value? How many times I got this question from clients or audiences? Is it time to ditch growth? And I just keep saying the same thing. I have no idea. I do know that 20 years from now, I'll be much happier having owned a subset of technology stocks than a bunch of banks and energy companies. So I'm not smart enough to know exactly the right date to get into value and get out of value, and therefore I don't play that game. And guess what? They were all wrong. There was no rotation. Growth is up 5 or 6% above the S&P this year, yet again, in a year that it was guaranteed value would outperform. So again, let's go back to long term. You cannot use things like inflation, interest rates, and so on, and the projections of such, rate hikes, and all this other stuff to dictate your investment thesis. If you are a stock picker and you're looking at individual companies, you may want to stay away from companies that are more exposed to rotating debt or higher debt loads and so on and so forth. You may want to buy companies that have more pricing power in an inflationary environment. And if you have the time and the wherewithal to do that, God bless you. But guarantee you, 10 years from now, you probably will not have beaten the S&P after all that hard work and toil, because that's just the fact. All the geniuses on Wall Street, with all their knowledge, 85% of them consistently underperform the S&P because the markets are very unpredictable. So I would say, David, don't worry about that kind of stuff. You're young enough, it'll work itself out. Anyone else?
If my job is to pick stocks, so that's
Then do what you're doing.
Just
My job is
he
not.
gave you the stock to pick, the S&P.
My job is not to pick stocks.
All right, David, any good?
He looks
Okay,
good.
amazing. Next question, Maya Metzer.
Hi, Maya.
And she's the founder of Psych Mike, by the way, Mark. She's an absolute superstar. Incredible.
She's writing up a white paper on me right now.
Oh, yeah. Oh, yeah.
Hi,
Yes,
Mark. How are you?
Good.
Okay, so I have a question that's psych related because I know nothing about finance. But I always say to my audience, which is comprised of undergraduate students who study psychology, is that a big mission of mine and my podcast is that I hope that it encourages more people to take their psychology background and apply it to more industries, in industries that we don't typically see psychology being applied. And I think you're a great example of that. But then I wonder, how would an industry like finance be different if everybody had an understanding of human decision making like you did? How do you think our worlds and our economy would be different?
I think that the market would be less volatile and more rational because the market is a voting machine of people and generally using emotion rather than intellect and knowledge. So the gyrations in the market or the volatility of the market are basically a cardiogram of people's emotional well-being at the moment that they're making a buy and sell decision. So if people approached decision making in a more rational way, the market would be more efficient over the short term. Over the long term, the market is extremely efficient. But over the short term, it's extremely inefficient. It would become more efficient.
Interesting. Thank you.
As far as investors are concerned, Maya, they would have a more lucrative experience. They would make fewer mistakes. If you want to read a great book, let me see if I have it. I do right here. This is a book worth reading.
What's it called?
It's called Why Smart People Make Big Money Mistakes by Gary Belsky and Tom Gilovich. It is a fantastic beginner behavioral finance book.
Guys, I'll throw in an extra one. I'm gonna buy it for the whole group. So I'm gonna buy it and I'll ship it to everyone's house. So I think we should all read this book because I
It's
think
an amazing book.
finance is very.
If you find this interesting, the book I would read after that is Danny Kahneman's Thinking Fast and Slow.
I've read that. It was a textbook, but I read it.
That's why I said you shouldn't read it first. This book is much more practical. It's applied. It'll make you a better investor.
What if I know nothing?
You know
About
something.
what?
That means you know enough.
No, what if I know nothing about investing at all? Where do I start?
If you know nothing about investing and you want to learn about investing, you can read any of Bogle's books that are really easy to read and understand what the stock market is, what's it comprised of, and what drives it over the long term.
Cool.
If you want to read something a little bit more academic, Peter Lynch's book, Stocks for the Long Run, is a very good book, but that's a little bit more textbooky.
Thank you.
You're
So we have a lot of questions. So
And we're running out of time. I'm so sorry.
It's okay. It's okay. I know we have like 5-10 minutes left. So
5 minutes. I have to.
5
do
minutes.
another
Yes, we got
class.
5 minutes. So let's go. Gilad, Nydia, Carl in literally a 5-minute cycle.
All right. Mark, thank you for being on. I guess my question is maybe the inverse of Maya's question because I come from a computer science background. Do you think that technology has a role to play in decision making in the markets, particularly with taking out some of that, irrational decision making that humans make? Is there a way for technology to play a role in, exploiting some of those maybe bad decisions?
Exploiting is the right word. I don't think it takes the volatility out. I think it exploits it and makes it worse. Because most of the robo trading systems that are built by firms like Goldman and JP Morgan are using momentum as their metrics. So they're basically saying, if everybody on this call goes bazookas together, it's going to start to show up in volume and in direction of the market. And we can predict that if Maya, Andrew, Hadar, and everybody else goes bazookas for 1 hour, they're probably going to get even worse 3 hours later as they watch the market continue to fall. And if we built an algorithm that can keep sort of their finger on the pulse of the market, we can actually continue to make money on that by shorting the market. And then vice versa, when everybody in this call becomes very ecstatic, they'll take. So what's happened is that these program tradings have actually made the volatility of the market worse during periods of turmoil. But the answer is yes. They've made fortunes of money for the likes of Goldman and JP Morgan.
Well, I have a lot of follow-up questions, but we'll save them for another time. Thank you.
Yeah, we might have to do another just Q&A. I mean, Mark, everyone has questions, so.
We could do another session of just Q&A.
Yeah, I think that would be amazing. But Nydia, go ahead.
Oh, can you guys hear me?
We can.
Perfect. Thank you so much for speaking, Mark. A question that I was going to ask is throughout while you were speaking, you mentioned this ability that you have to continually trust your intuition and your gut. And I think my question for you would be, even outside the space of finance, how do you make sure that, in the face of pressure or other people having a certain perspective, you're able to know when to trust kind of intuition and perspective? Because I think especially being young, we're always shown so many different paths or decisions that we can make. How do you know which one kind of is the right one for you or when to stick to your own decision?
So it's a great question. I built my intuition over years, and I built it from learning from really smart people. I also built it by, as I diminished my ego, my intuition became much more pronounced and reliable. the thing that gets in the way of intuition is bias. When you're biased, when you want something to be your way or a certain way, that will cloud decision making. And when a person is biased, they cannot trust their intuition. So whenever I have a reason to believe that I am conflicted and for some reason biased, I will not trust my intuition. I will speak to somebody who is unbiased, somebody who's outside of the problem. That's point number one. Point number two is I only trust my intuition when and if I can put myself into a state of calm. When I am agitated, nervous, fearful, greedy, I make my biggest mistakes. So you won't be surprised. I do meditation. I've studied hypnosis. I must get into a place of quiet. When I'm in a place of quiet, I can listen to and understand where my intuitions are coming from. If they're coming from a bad place, I will not act. I've made my biggest mistakes following intuition that I didn't know what the source was from. Does that make sense?
Thank you so much, Mark. Yeah, that was a really great answer.
But where you are today, you're doing a lot more learning than you are trusting your intuition. But when it comes to meeting a guy, trust your intuition.
I'll take your advice on that. Thank you, Mark.
You're welcome. We have time for no, we don't have any more time.
No.
Okay,
We'll do another Q&A. We'll do another.
No problem. I'll sign up for that.
Mark, thank you so much for being on BU. This was absolutely fantastic.
Thank you.
Thank you so much for being here. We appreciate
My
it.
pleasure. Take care, everyone. You were a great audience.
Thank you.
Appreciate you, Mark. Thank you.
Thank you.
Thank you, Mark.
Thank you.
Thank you so much.
Thank you.